So let's get started without further delay. And if you are joining us today, make sure you have something ready to jot down some notes because we will be going over lots of things in this private briefing. Okay. So welcome to your private tax intelligence briefing. Let me first share my screen. I would love to see where people are joining us from today. If we can put it in the chat box, where are you joining us today from? Let's hear from few of you. Let me get my chat situated again. Oh, California, New York, Panama. Okay. Okay. Alrighty. So let's get going. Welcome to your private tax intelligence briefing, everyone. We called this as a private intelligence briefing intentionally because what you're about to see in this session is not public. It's not in the headlines, and it's not what most CPA offices are talking about. And you will not hear this anywhere else. If you're here, it's because you have outgrown guesswork and maybe you have built something real and now you're asking, where's the protection, right? Where's the protection that matches what I have built all this year along, right? So today we will walk you through what One Big Beautiful Bill Act, or we are going to refer to this as OBBA, OBBBA, to make it a little bit short, changed behind the scenes, and more importantly, what most planners are still missing, okay? Because when you realize how much you have been quietly overpaying, protection becomes non-negotiable, right? So let's take a look at the agenda. The agenda is the truth behind the One Big Beautiful Bill, 5 strategic moves still available in 2025, and how strategy stacking creates 50 to even $500,000 in tax savings, 50,000 to $500,000 in tax savings, and the framework behind 65 million plus in tax savings. What to do now while you still have time before the year ends. And again, I'm not here today to impress you with the volume. I'm here to walk you through few critical truths that if you apply them in time, could protect you 6 to 7 figure this year alone, even in less than 5 months remaining for the year before the year ends. I'm saying less than 5 years because we have to be mindful of the holidays coming in as well, right? I grew up watching my father work harder than anyone I have ever met. And my mother, who never went to school, but she was the CFO of our home, and every dollar mattered. Every decision was calculated, and there was always a hustle, but never enough. It was all about, everything was so stretched. My parents were always working, and when others had celebrations, we just kept going. And zero complaints from my parents. I'm really grateful for the life that they have given me. Otherwise, I would not have been here today and speaking in front of you all today. But the life back then was more about survival. Taruna, you see it here on the other screen. She is my elder sister who was the first girl in our family to study beyond high school. None of my parents are educated. Sorry, Taruna, go ahead.
Yes, Lisa. Hello, everyone. Wanted to greet everybody. Thanks so much for joining today.
Yeah, none of my parents were educated, and no other cousins on both the sides were educated beyond the high school. And I followed her footsteps. But when I said I wanted to become a CPA, my father said no. Not because he didn't believe in me, but because fear was louder than the hope. He was scared. Scared. What if I failed? What if I got married and my husband's family didn't allow me to study? And in our family, the old belief was don't invest in daughters. They will just get married and leave. But I couldn't unsee the future I felt in my bones. And I literally cried for 4 days because I knew this was my path. And eventually he said it too, and he said yes. And yes, that one yes changed everything, not just for me, but for all of us. I became a CPA and I was very proud. But very quickly, I realized something shocking. Most CPAs aren't trained to help clients keep their money. They are trained to report the past, the history, not to build the future. And that's what, most people reach out to the accountants to build future more so than about the past. Reporting past is just a formality, putting in right numbers in the right boxes and calling it a day. But that's why I went deeper. And I became a certified tax strategist. And I studied advisory, many business planning, wealth structuring, trainings, and a lot of that, because that's what actually changes lives. And with my sister, I co founded KB Tax Advisors. And today we own over 800 doors on multifamily units, storage unit, apartments, and we mentor other CPAs nationwide as well and help business owner design the legacy they were told they couldn't have. Because in a family where women weren't even expected to finish the school, we built something that literally changed everything. And now that you know who we are, let's talk about what we can do for you today. So, you don't need another CPA. Let's simply put it here, okay? At KB Tax, we work with the business owners who have outgrown the file and hope model working with their CPAs. Just file and hope, right? Tell me, to put it in the chat box if you have heard of this from your accountant, file and hope that everything will be good, right? They don't just want someone to prepare taxes, they want a strategist who sees the full picture, right? And they're building something real and they want their tax plan to match their vision, their values, and their future. And that's what we do. Every plan we create is personalized, it's proactive, and it's designed to give you the clarity you have been missing all this time. And we have helped clients reclaim over $65 million in silent tax overpayments. If it was not for the tax strategies, this money would have been donated to the IRS, and this $65 million have been saved ethically, legally, with audit aligned tax strategies. The other day, one client literally said, we saved $112,000 a year. And finally, I feel that I'm in control again. And that's not just a financial win, that's a shift in power, right? Because when you stop overpaying in silence, you stop playing small. You lead differently, you make decisions differently. And that's what this work really looks about, right? That's what it's all about. This isn't about beating up the IRS, it's about aligning your wealth with your worth and increasing your net worth. You got into the business to increase your net worth, not just to pay the taxes, right? Oops. Here we are. The shift from survival to strategy. Before we dive into the strategy, I want to honor what it took to get here, okay? And for many of us, the survival taught you have to stretch, have to lead, have to build under pressure. But survival was never meant to be the end of your story, right? Because while you were focused on building and protecting what you have earned, Congress quietly passed that big, beautiful Bill Act that is literally reshaping the entire tax landscape. And if your tax strategy hasn't evolved since the passing of this new tax bill, you already may be on a track to overpay. So let's look at what actually changed. And if this is already resonating with you so far, just say yes in the chat. So I know you are with me. I'm not just talking to the blank screen in front of me. So just say yes, or just put some message in the chat box. So I know I have real people on the other side. Okay, thank you, Tammy. Thank you, Stephanie. I hear you now. So let's see what changed and why it matters now than ever before. In 2022, Congress passed a 300 plus page tax bill, and it quietly rewrote how we handle everything, how we handle our business deductions, retirement strategies, real estate structuring, entity level planning, and timing and depreciation windows. Most business owners and many CPAs missed this, and they focused on paperwork, not on the protection. And I'm not saying by any means that any CPA or accountant is negligent or incompetent. They are only doing what they have been taught in our CPA curriculum. If it was not for my family's dynamics, I would not have, spent this time learning all this thing that we are talking about today. So this is not about saying any bad thing about another CPA. But what if you have been giving it away year after year, those precious capital bills, through your missing out on the tax strategies, and you did not even know without knowing it. If you're still using a tax plan that was designed before the One Big Beautiful Bill Act, it's like you are planning your road trip with a 2019 map. Just imagine. Back then, we used to use GPS and all of those sort of things, right? And the exits you need aren't even on it, right? Would you still use 2019 map to drive your car and reach to your destination right now? No. Then why would you use the old tax plan, which has changed, and expect the same result or even better result, and every year get disappointed again? The silent drain, you didn't see it was coming, Most overpayments don't happen because of mistakes. No, it doesn't. They happen silently because of outdated structures, because of missed timings, not aligning well, missed deductions that were never claimed. The truth is, it doesn't look like a red flag. It doesn't come with any warning. It just looks like a slightly larger check to the IRS, during the quarterly tax payment or at the end of the year. So it's like every quarter you're paying bigger and bigger in taxes. And here's the harder truth. Your CPA may not even see it, because if they're filing last year's number, they're already behind your future. So let's take a moment here, just 10 seconds. If I handed you $50,000 refund check today, fully legally, fully yours, where would it go? Let's launch the poll. I hope, Taruna, we have the poll here when I'm promising everyone. Okay, let's take a moment and let's take the poll. Pick the one that would feel like the biggest relief or the greatest reward right now. There's no right answer, just what's calling you right now. And if you feel like adding more, drop a word in the chat, and just one word, where would that $50,000 go, if we were to get you that much of money from your taxes? I see a lot of people taking survey, so taking poll. Let's give 3 more seconds. Okay. 1, 2, and 3. Okay, so I'm going to end the poll right now, and let's see. We have some people saying pay off the debt, owner distribution or savings. Some people saying strategic reinvestment, could be growth, equipment, launching new business ideas. We have some people, 20% of the people saying giving back, donations, causes, community impact. Well, I really appreciate all of you on that side, and that's a cost of outdated strategy. And that's what we are here to change today. One of our clients last year said, and again, this is a high earning coaching consultant, and they thought they were doing everything right. But when we found $72,000 leaking because of the QBI setup was not correct with their S Corp, that was a big one. They didn't change their income. It was just the structure, and that's what the strategy does. And that's what we are here to fix today. So let's move on to the 5, not the 5 strategy. Let's move on to the next slide, the nothing burger tax menu. It's served hot and full of false hopes. This is the menu most business owners are served when they ask about their tax planning services to the accountant. Auto loan interest sounds comforting, but almost never applicable to real business owners. Tax-free Social Security sounds nice until you realize it's phased out the minute you are considered a high earner. QBI deductions, those phase out quietly and quickly for many, and few realize they're not actually getting the full 20%, even if they are under the phase-out limit. SALT cap, state deductions, state tax deductions, workarounds. Even the best ones still miss, and they are still limited. The cap is $40,000, again, temporarily, but it shrinks right back when your income increases above $500,000. And then there's a max out everything and hope for the best strategy, right? It's the CPA version of wishful thinking and not protection. So if this is what's on the outdated menu, what's actually still available in 2025? Let's walk through the strategic planning windows still open before they quietly close. And if you have not grabbed your pen and paper by this time, grab something to jot down lots of notes, because what I'm about to share is really going to blow your minds. So let's move on to the next one, where the One Big Beautiful Bill Act works in your favor. Let's talk about what still works if you act with the strategy, with the intention. The One Big Beautiful Bill Act did not remove the opportunities, but it narrowed the doors. So here's where planning, especially at the 300,000 plus worth of AGI or taxable income, it still pays off, okay? So 100% bonus depreciations are back. You can fully write off 100% bonus depreciation. You can claim up to $2.5 million, Section 179. QBI deductions are extended. Don't get too excited on this because QBI starts phasing down the moment your income increases 600,000 and more. But $600,000 worth of income, your QBI is completely zero. Child care and R&D credits are boosted again, and estate exemption locked at $15 million. So protect your legacy before the thresholds shift again. And none of this is automatic, okay? It takes awareness and aligned action to make it count and to really realize the tax savings. So what does the One Big Beautiful takes away quietly but significantly, and you will not hear about this from most places? It's shrinking your SALT deductions. You do get up to $40,000 worth of SALT deductions, which used to be $10,000 in the past. However, the moment your income hits 500,000 or more, it's pretty much you're back to $10,000 again. QBI partial benefits over $394,000. It full phase out by $494,000 for joint owners. Earlier I said $600,000. I think I mixed those numbers, but it's a QBI phases out completely at $494,000. So planning is essential, especially if your overall taxable income is more than $400,000. I shouldn't say taxable income. If your overall AGI is more than $400,000. EV and energy credits disappear after 2025, electronic vehicles and energy credits. QSBS partial benefits only post July 4, 2025 stock qualifies, and only with a 5-year hold requirement. If you were holding these stocks less than 5 years, you're not eligible. Charitable limits and AMT clawback. So 50% AMT limit plus new caps reduced actual benefits. So on the surface, it looks good. But if you dig deeper, it's pretty much for high earners or people who make more than $400,000 worth of income. You're not benefiting much from the One Big Beautiful Bill Act. It's more beneficial for someone who earns less than $300,000 in income. But anything with more than $300,000 in income, this bill is not doing much for you. So 5 strategic plays to put $50,000 to $100,000 back in your hands. Now that you have seen what on the surface, what One Big Beautiful Bill is really doing behind the scenes, let's shift into the strategy. When we put together this private briefing, the plan was to walk you through 3 powerful tax moves that are available in 2025. But because you all showed up live, and when I was preparing this presentation, I'm like, we need to be more generous. Let's kind of give you more because you are the kind of leader who carves out time to plan ahead. And I'm going to give you 5 different tax strategies today. And you may not need to use all of them, but even if you use just one of them, that could save you $50,000 to $100,000 or maybe even more back in your hands this year before the year ends. So if you are excited about it, let's see some movement in the chat box or maybe give some reactions. I don't know if you can even do that on the Zoom. So let's see. If you're excited, let's see that in the chat. Yeah, let's go, Tammy. So strategic move number 1, 100% bonus depreciation. But I would say it's not the best move. but I'll go over it. Some people get excited about this, right? So deduct the full cost of your qualified assets in 2025. So let's take an example. If you're planning to buy a car or planning to buy an equipment, if that is already in your agenda, making this move now can give you 100% depreciation deduction, or I should say 100% bonus depreciation deduction. And if you're someone in a 40% tax bracket, state and federal combined, that's almost 48,271 in tax savings. But you're out of pocket by $100,000, right? We need to have that much of cash flow, $100,000 to invest in something to save $48,000 in taxes. Now, here's something to remember, that if it is already in your agenda to buy a car, then this is a good move, or an equipment or an asset, that's a good move. If it's not in your agenda and you're just putting money in something, buying a toy that you don't really need, that's a cash flow drainage. It's not really a smart move, okay? So, and this is for the first time I'm discussing this elite strategies in a private briefing today, okay? I have never shared this before, but this is the first time I'm sharing this. So let's look at the smarter tax leverage options. Bonus depreciation or high ratio strategies. So let's take an example of someone with a combined W-2 or business income $1 million, okay? No strategy with $1 million worth of income, your total tax liability is going to be $371,000. Ignore this 35% tax bracket because at $1 million, you're already in a 37% highest tax bracket. So out of your $1 million taxable income, after you pay the total tax liability, your take home cash flow is only $628,000. That's it, pretty much. But if you're buying a car or an asset or equipment, $100,000, provided your business needs it, okay? That is going to give you strategy deduction of $100,000 as a depreciation deduction, bringing down your AGI to $900,000, taxable income $870, and as a result, total tax liability $322,000. So the total take-home cash flow is $577,000. Yes, we saved money, $48,000, yeah, but take-home cash flow has reduced substantially, right? Let's look at the leasing strategy. We call that as a 4:1 tax strategy, okay? Where we are investing, we are not buying, we are investing in an equipment leasing strategy. So it pays you about 5% growth income every year. So that's $5,000 in income. Now we are earning money, okay? The strategy deduction is $400,000, okay? Our AGI reduced to $605,000. Look at the taxable income, $575 versus $970,000. And our total tax liability is $188,000. It's less than half of the original tax liability. And look at that take home cash flow, $716,000 worth of cash remaining in our hands, whether you want to pay off that debt, you want to donate it to the charity, or you want to grow your business, launch new business idea, open another location, and the tax savings of $182,000. And this $400,000 strategy deduction is coming from the equipment leasing strategy. So what we are doing here, instead of buying a car for $100,000 and getting a deduction worth of $100,000, here we are investing in an equipment leasing strategy for $100,000, but it gives me deductions worth of $400,000 instead of just $100,000. So it's not giving me 1:1 deduction, 4:1 deduction. And with the SaaS software strategy, it even gets better, okay? It's giving a strategy deduction worth $600,000 instead of $100,000. Again, the cash outflow required or the investment required with any of these three strategy is same $100,000 out of pocket. But look at the buying power of that $100,000. This $100,000 here is buying you deductions, what, $400,000? And here $600,000. And we are earning income every year, 5,000 or 6,000, whatever you call it, on an annual basis. And with the SaaS software strategy, which is 6:1, our total tax has reduced to $105,000 overall liability. So our total take home cash flow is $800,000 and the tax savings is $266,000. And that's what real wealthy people do. This is where, most people stop either here at baseline or buy a car and that's it. They just grab the bonus depreciation and feel done. But what we are doing here is more leveraged, more efficient, and far more cash, smart, same tax code, just better design, right? Just seeing where we are getting more worth for our money. And we are not postponing taxes, okay? We are eliminating taxes. We are not postponing them, okay? This is not a tax deferral strategy. And, I forgot to mention it earlier. If anyone has questions, feel free to put it in Q&A section. So if we have extra time after we go over all the strategy, I'll cover those questions as well. Okay, so let's move on to the next one. Overall, in a nutshell, buying a car versus leasing the equipment leasing strategy or SaaS strategy, what we are talking about is $87,000 more gain with the baseline comparison, or $172,000 more gain. With the car purchase, it's even more, $139,000 or $223,000. And that's a lot more money. So that's kind of there. Let's move on to the strategic move 2. This move is one of the best kept secret of the One Big Beautiful Bill Act. Okay, and this deduction innovation can apply towards the present expenses or even the past expenses. There are very few limited strategies that you can go back in the past, back to 22, 23, 24, and retrospectively use it. And this is one of them. So with the R&D tax credits, it's a full immediate deduction of domestic R&D and software development is allowed again back starting 2025. Last few years, if you remember, we were not able to get immediate deduction. It was being amortized across the 5 years. But here's where it gets even better. If you're a small business and your business revenue is under $31 million, you may be eligible to amend previous year's tax returns and take the full deductions for 2022, 2023, and 2024. That means it's a potential refund, right? Not just future savings. It's a right away refund on the surface. So, no more 5-year amortization is required. You can deduct everything, and it includes software development, product testing, prototypes, any automation tools, internal process innovation, any of those. Now, I'll give you an example of a dental group who invested about $120,000 in a treatment plan software back in 2023. Under the old rule, they could deduct $24,000 for 5 years. With the new rule, we went back and amended 2023 tax return, and they got a refund for $120,000. So, $120,000 worth of credit. Sorry, not the refund. The actual refund was $42,000. So this is a dollar for dollar credit, and if you're building, improving, or innovating, you may already qualify. What IRS looks at is the process improvement. They look at the internal software, new product development, or even custom tooling. If you're creating a better system, innovating how you deliver your products or your services, or building tools internally, that increases your efficiency and productivity, you may qualify. And the best part, most high income business owners are always doing this kind of work. They just haven't been advised that it's deductible and they can claim credit. And when you have a choice to claim credit, claim the credit over the deduction, because credits are dollar for dollar. When it comes to the taxes, deductions gets discounted with the tax bracket. Strategic move 3, the SALT shift. Deduct what you're already paying, right? The ABA raises the SALT deduction cap to $40,000. But again, it phases out completely when your taxable income is above $600,000. Sorry, when your AGI is above the $600,000, not your taxable income. So when your AGI is $600,000 or more, you get that old same $10,000 SALT tax deduction. So there's a workaround, and that's what I'm going to talk about. Elect the pass-through entity tax. Depending on the state you are in, your state may allow you to do PTET election, and it shifts your state tax liability from personal side to the business side. And when business is paying for these taxes, it's a tax deductible expense. There is no SALT cap. Now remember, it's important to shift and make an election. You just cannot pay the personal taxes from business and assume that you're going to get the PTT deduction. No, your accountant is going to put it into draws or distributions. So, let's take an example for someone in California, $600,000 worth of income and $60,000 in state tax. If they make a PTET election, $60,000 is now deductible at the entity level, can be paid by the business, and as a result, the federal tax saving is $21,000. It's the same tax, just a smarter placement. And the more income you earn, the more valuable this move becomes. The tax strategic move number 4, structure smarter, pay less. Most high income business owners don't realize that the 20% QBI deduction is not automatic. For joint filers, it starts phasing out at $394,000 in income, and it completely disappears at $494,000 worth of income unless you are structured the right way. And even then, you have tools like strategic layering, right? Things like converting to an S Corp, make the PTT election, maybe compensation rebalancing, making qualified charitable contributions at the personal side, that will bring down your AGI. This $494,000 is the AGI limit, not the business profit. Leveraging bonus depreciation deduction strategies or SaaS software or equipment leasing strategies. Overall, combinations of these tax strategies can reduce your AGI, and it makes you eligible for the QBI deduction. And this is where tax planning becomes more proactive and important, because you're not just reacting to income, you're reshaping how much you're going to keep home at the end of the year. And when QBI is at risk, structure and strategy are the only options to bring it back. I want to mention one more thing about the QBI. I see this so many times. In an effort to pay lesser taxes, people try to write off everything they can, okay? And as a result, they generate loss in their business. When you have a loss in your business, you get $0 in QBI. So you have to be mindful about that. How much you want to write off and how you can get maximum QBI deduction. These are the two different things. To get the maximum QBI deduction, you don't have to write off everything, but write off something that really moves the needle and it's worth it. So It's a very important strategic move that most people and most accountants make a big mistake on. Let's talk about strategic move 5. The power of strategic layering. And let me show you what we call strategic layering and where we stack moves together instead of treating them like isolated tactics, okay? So let's take this example where we have someone who has about $1 million worth of W-2 or business income, no strategy at all. With the $1 million in income, after their standard deductions, federal tax, state tax, everything, their total tax liability is $323,000 and they take home about $676,000. Now, with $60,000 backdoor Roth conversion, of course, their income is going to increase $1 million versus $1,060,000. However, even with that, when we look at the taxes, it's $348,000 and take home money is $651,000. Now, when we add in oil and gas strategy, let's say Roth IRA conversion, and with oil and gas, that full $60,000 is invested in, towards the oil and gas. So this entire Roth conversion is zero taxable, no tax at all. Their taxable income dropped again to $970,000, and we are back to the square one, same tax liability, 323. But their oil and gas contribution is $71,000, and their total take-home money is $604,000. Now, if we go with the Roth IRA tax strategy with fee simple leverage donation strategy, compare here with the fee simple leverage donation, which is 4:1 tax strategy. Taruna, remind me if it is 5:1. Actually, it is 5:1, right? Yeah. So fee simple leverage donation strategy is 5:1. You get $318,000 worth of deductions, charitable deductions, and your total tax liability is dropped to $229,000 compared to $323,000. And our take-home money available is $706,000 is what our take-home money versus $676,000. And when we combine oil and gas, fee simple leverage donation, and solar tax credit, okay, it gets even more exciting. Solar depreciation, $288,000, but on the other side, they get solar income. Who doesn't like earning income, right? $240,000. So taxable income is $709, and overall tax liability is $79,000. Look at that. $1 million in income and tax liability $79,000, not six figure, not 323, $79,000. And their take home money is $739,000. And that's what real tax strategy looks like. And this is what tax planning looks like. Tax planning is not planning just your estimated tax payment. This is what is tax planning. And it's built custom to you and around you. And I know this feels like a lot, and that's okay, because I want you to see what is possible. And you're not expected to figure it out all on your own. The tax code was not written to be simple, right? And most CPAs aren't equipped to connect the dots the way these strategies require, right? But you don't need to be the expert. That's what we are here for. And our role is to take what you're already doing, your income, your goals, your values, and design a tax plan that protects everything. And you don't have to guess it anymore. Tarun, I see you have your hand raised.
Yeah, so I mean, it's definitely a good way of using the power of strategic layering, but it's not just applicable to current year. So I just wanted to remind audience that some of these strategies can be utilized to recoup some of the tax you may have paid in earlier prior years. Like, we can go back to 3 years. So it's very powerful if you consider that.
Okay. Okay, yeah, that's very, very good ad on that side. Let's move on to the next one. Meet our client Courtney, and she is a successful marketing agency owner, but still felt like she was barely hanging on. And we found almost about $64,000 just sitting in her prior year's tax return. And when we went back and amended it, she received a $64,000 refund. And then we built a plan, real plan, and now she saves over $50,000 to $60,000 in taxes annually every year. And she used this money to hire in-house HR and lots of managers in her company. She expanded and even acquired another marketing agency. And she moved out of her residence in California to Texas. She did not sell her house. That's an important thing, right? Um, and it's all functioned and functioning better for her in terms of tax positioning. And this is her words. I don't have to be afraid anymore. I feel like I can weather any storm. So that's kind of a very powerful feeling as a business owner, and especially as a woman business owner. And Courtney used to feel like she was working harder than before, and she was taking home less and less and less every year. And she didn't know what I could expand or invest in. And now she's saying she saves $50,000 plus year, and she's actually planning for her exit. And she's not an exception. She's the proof of what happens when you stop leaving money on the table and start planning like a real business owner, the real leader you are. And let me show you the framework we use to get there. The real framework is our proprietary profit method. It is our step-by-step process designed to help high income earners like you on how to reduce your taxes, protect your assets, and grow your wealth with precision. And this is the exact same framework we have utilized to save our clients over $65 million in taxes. And it starts with P, position, you know, deep discovery session to understand your goals, your lifestyles, your financial roadblocks. And then R is for restructuring your entities, your income, your building your custom tax plan around your unique situation, around your lifestyle, business, wealth goals. O is for optimizing with precision, where we unlock different deductions, credits, loopholes, timing, which is very important, timing of the strategies, and turning every financial move into a growth lever. And then 45, where we go beyond, above and beyond to protect your assets. And with the audit proof, audit ready, documentation, or any kind of a lawsuit resistant structures. And then we implement everything that we have identified, designed, and structured with the live calls, hand holding, providing you guided checklist. It's more of done for you execution, so there are no confusion, no missteps. And then track and refine, continue to refine on an ongoing basis. That's what we do during the quarterly meetings and year-end reviews and filing for next year's win. This is the entire framework that we have utilized again and again for our clients. So what it looks like to work with us is, what we have seen work best for business owners: structured tax planning throughout the whole year, not just one time, quarterly tax strategy meetings, and then proactive approach that legally reduce your tax liability, right? So, it all starts with the discovery and strategy session. Now, I would highly encourage our attendees to test your current CPA. Tell them to email, tell them by sending them an email, can we have structured quarterly meetings for tax planning side? And let's see what you get. Or ask them, can we discuss proactive tax strategies instead of just preparing returns, and see what you get? It's very important what kind of a role, active role, that they are going to play with you, because it boils down to your confidence, your decision making, all of that. And then, who is this right fit for? is, oops, am I frozen on my end? Okay, okay, it's working back now. Who is this for? You're a great fit to schedule the discovery call. If you earn over $400,000 and you know you're overpaying in taxes, anyone who is paying more than $50,000 in taxes is a great fit. You want a long-term strategic plan, not just a quick fix. And you're done guessing. You have outgrown that file and hope model and want expert implementation. You value ethical, high performance strategies. And if all of this are good, but if you're not ready to act before 2025 closes, please do not reach out. So it's very critical that you're willing to act before 2025 closes, because a lot of these strategic moves will be lost forever after the year ends because we cannot go back and recreate bank transactions, right? So let's design your 2025 tax strategy together, you know. And if any of our time together, any of the strategic moves, anything has resonated, and if you want more clarity or strategy or a real plan, we would love to help you. For the first 10 attendees, we are offering a complimentary discovery session. We will go through your tax situation, uncover opportunities, and show you how much money you are leaving on the table. This isn't a sales pitch, it's a strategy. This is a strategy. And you can use the link on the screen now to reserve your spot. Or, Taruna, I think let's put this link into the Zoom chat to make it easy for people. And let's take, we have 3-4 minutes, so let's take over a couple of questions. I see a question. What's the fastest way to know I'm overpaying in tax and I'm worried? I know it worries me too when I hear, someone is overpaying taxes, and it reminds me of my childhood memories. And I want you to know the fastest step would be click on the link, schedule the call. You have nothing to lose. You will get a second opinion. How good of a job your current accountant is doing. And we will take a look at your most recent tax return or current financials, go over some questions and whatnot. And our team is competent enough that they can tell you with exact numbers how much you're overpaying in taxes. And if it resonates, we can talk about how we can help you further. But I would say take action. Not taking action, it's costing you lost opportunities. So take action. I have a question coming from someone. What is the $400,000, $600,000? I don't understand, and where that is coming from. I think you're referencing to equipment leasing strategy or SaaS software strategy, which I discussed earlier. If these numbers were that easy, most accountant would have been talking about it, right? And you would see it in every single TikTok videos and everywhere. Just kidding. These are highly sophisticated numbers, and these numbers, were about, so in a very simple layman's language, with the equipment leasing strategy, if you're investing $100,000 in that strategy, you get $400,000 worth of tax deduction. Same with the SaaS software strategy. If you're investing $100,000 in that strategy, you get $600,000 worth of deduction as a depreciation. And both of this tax strategy, you earn anywhere 5 to 6% annual income. Okay. I have a question. If I book a call today, how quickly can you get started on my evaluation? Well, if you book a call today, then, I would say within a week or so at the max, depending on how quickly we get the documents from you and how quickly we review it. But I would say within a week, you would have a concrete answer how good of a job your accountant is doing and how much you are leaving on the table. I mean, if you don't do any other tax strategies at all, Just take the leap of faith, schedule the call. It is fascinating to know how much money you're leaving on the table. Listen, when you are doing performance appraisal or when you're renewing any kind of a contract, you think twice. You review it again and again. You sit down and do performance analysis or contract analysis before you sign that next contract. Yet you have been signing your tax return year after year, feeling like punishment at the end of the year, cutting a check to the IRS and not thinking it again. So, whether you book a session or just took away a new insight, I'm grateful that you were here. I know this is a lot, but the right next step is simple. Don't keep guessing. Let's stop doing it alone and start doing it with structure. And thank you again. I will, take over a little bit more questions next time around. And if I missed any of your questions, feel free to send me an email and my team or I myself will get back to you. And I really appreciate you all for giving valuable time out of your busy schedule today and joining this session. And if there is any particular topic you want me to cover in future, send me messages or put it in the chat box. I would love to cover those topics in our next session. I will see you again next month on another topic. Okay? Thank you so much, everyone, and bye for now.